In 2023, the world witnessed a banking crisis that shook the foundations of the global financial system. Today, we bring you an in-depth exploration of the 2023 U.S. banking crisis. Get ready to uncover the reasons behind the collapse, its aftermath, and the far-reaching impact it had on the economy. Our story begins with Silicon Valley Bank, SVB, a renowned institution catering to fast-growing but often loss-making businesses. When central banks decided to combat inflation by raising interest rates, SVB faced significant challenges. Venture capital started drying up, and borrowing costs skyrocketed for SVB's clients. As a result, a wave of deposit withdrawals ensued, straining SVB's liquidity. Desperate to fill the gap, SVB sold a portion of its investment portfolio at a substantial loss, exacerbating the situation. Despite efforts to raise fresh capital, SVB faltered. Influential venture capitalists advised businesses to withdraw their funds, further deepening the crisis. Eventually, regulators stepped in, and on March 10, 2023, SVB met its unfortunate demise, marking it as the second-largest bank failure in U.S. history. With over $200 billion in assets and $340 billion of client funds, SVB's collapse sent shockwaves through the industry. But every crisis carries within it a glimmer of hope. First Citizens Bank shares emerged as the savior, acquiring SVB's assets in a daring move. They absorbed approximately $110 billion worth of assets, $56 billion of deposits, and $72 billion of loans from the collapsed giant. The acquisition enabled First Citizens to experience rapid growth, leading to a surge in its share price. Regulators played their part by providing cash and additional funding to support the acquisition. However, the Federal Deposit Insurance Corps, FDIC, still had a mammoth task of managing around $90 billion of SVB's securities and assets. Unfortunately, the crisis did not end there. Shortly after SVB's collapse, Signature Bank faced a similar fate. The news of SVB's failure triggered a wave of client withdrawals from Signature Bank, leaving the institution reeling. Since a significant portion of their deposits came from businesses and the majority were uninsured, clients sought refuge in more stable financial institutions. On March 12, 2023, regulators closed Signature Bank, marking it as the third-largest banking collapse in U.S. history. Amidst the chaos, New York Community Bank, NYCB, stepped forward to salvage what they could from Signature Bank. NYCB's subsidiary, Flagstar, took over nearly $13 billion in loans and the majority of Signature Bank's deposits. The acquisition brought a glimmer of hope, boosting NYCB's share price, while ratings agencies maintained their faith in the institution. However, the FDIC faced the daunting task of managing approximately $60 billion worth of Signature Bank's assets, including its cryptocurrency unit, Signet. The collapse of Silicon Valley Bank and Signature Bank sent shockwaves throughout the banking sector, triggering concerns of a broader crisis. Fear and uncertainty spread like wildfire, reaching smaller regional lenders such as Western Alliance, East West Bancorp, Fifth Third Bancorp, and KeyCorp. These institutions experienced a decline in their stock prices as customers grew worried about potential losses. In response to the crisis, major U.S. banks, including J.P. Morgan, Bank of America, Citigroup, and Wells Fargo, stepped up to pledge $30 billion of their deposits to First Republic, one of the hardest-hit regional banks. The injection of funds aimed to stabilize First Republic's liquidity and prevent further turmoil. However, the challenges for First Republic persist, and the institution is exploring various options, including a potential sale or downsizing its operations. Looking towards the future, authorities have taken significant steps to prevent similar crises. Regulatory bodies are reviewing and strengthening the oversight and risk management practices of banks. Additionally, governments and central banks are working together to implement robust policies and measures to ensure financial stability and prevent future collapses. The 2023 U.S. banking crisis serves as a strong reminder of the fragility of the financial system and the interconnectedness of banks. It highlights the importance of prudent risk management, effective regulatory oversight, and the need for timely intervention to prevent catastrophic consequences. As we navigate the aftermath of this crisis, it is crucial for all stakeholders to work together to rebuild trust and learn from the mistakes of the past. Thank you for joining us on this journey through the 2023 U.S. banking crisis. Remember to stay informed, stay vigilant, and stay prepared. Until next time.